When it comes to building or designing a self-storage facility, it is so important to have the best experts in your corner that know and truly understand the self-storage asset class. You don't want to be making mistakes. You don't want to have the wrong people in your corner at the beginning. You want to have all the right people. And that's why we brought an in-house architect into Cedar Creek Capital to help you guys better design your facilities right from the get-go to optimize that square footage and therefore that revenue right from the beginning. Follow the link below in the show notes, get in touch with us, and our in-house architect can start working with you today.
Welcome everybody to the Self-Storage Income Podcast. And today we are starting from like foundational stuff that is foundational, but it actually grows and can get a lot more complex and complicated. But this is a great topic because it is at the core of our business strategy. And in fact, it was what a long time ago, I think, I started talking about, I started speaking on a long time ago. It was kind of where I more made a name for myself in self-storage. And that was the fact that self-storage is not a real estate investment. It is a business. And that's how we treated it. And now that is much more commonly accepted, especially after the book, Creating Wealth in Self-Storage. And that was the whole entire premise of the book, right? And I think that's why the book did so well, and I was shocked by it, was it came out, and I really had, when I started talking about this like on stage and everything, I got a lot of feedback that people wanted me to come talk a lot more, where it was our very simplistic approach. This was a while ago. This wasn't anytime soon. So back in the day, you young kids. But it was talking about how the way that everybody approached storage and treated it was more traditional to other types of real estate asset classes. And we didn't treat it like that at all. We treated it, when I say treated it, I mean we looked for potentials, we underwrote, and we ran them like a business. And that changed the way that we did a lot of things. And it was very different from most real estate people, and still is. Most real estate people that come in, I think they view the asset similar. It's like, okay, it's a business, but it's real estate. We're going to do the same things that we would do on other real estate properties to create yield. And we operate differently, right? But that's why the book did so well. And I think it was because it struck a chord with especially people in the industry where they were like, yes, thank you.
Yeah,
that is correct.
Right. Yeah. Especially in real estate, like you said, you've got all of these very real estate centric focused people that are looking, we've even had the conversations with these people where they're coming in, they're saying, okay, yeah, so, valuing something X, Y, Z, they're looking at comps. They're doing all these different things like normal real estate people do. And it's like, no. Like that's not what you need to do. Like don't be looking at the comps. Don't be looking at this. Like you're looking at the business. You're buying on cash flow. You're buying what you can achieve through that. As far as what that spread is, it's not okay, well, this one down the street is doing this, so this is what this one needs to be doing. It's not like you're comparing values in a certain way like that. So
we talked about this even last week on the podcast when we had a discussion on revenue management and how it can get more complex, and that's really hard for people to understand, especially financial institutions. This idea that, and I believe we talked about it on last week's podcast where we talked about how things changed so much, but we talked about what was driving technology and things was changed. But I'm pretty sure we mentioned and we talked about this spread of in-place versus street rates and how it is so wildly different from any other asset class that even banks can't get around it, meaning that we have this problem. So I actually expressed this problem with the bank, and we're trying to get the bank over. And two, there's not an answer. It's not because, by the way, here, I'm not saying the bank is stupid or they're even doing it wrong. It is the divergence, though, of how you finance and how you look at real estate assets to a business, meaning that when I go out and buy a business that's, let's say it's a 3x multiple of gross revenue, I'm going to the bank and I'm showing, look at how we can increase this revenue, everything else, which we do that with banks. But here's the problem. So banks zero out numbers today. And I believe we talked more in depth. Go watch the other one to get into revenue management more deeply, because we're not going to talk about that in depth here. But they zero it out, meaning that, all right, what are the street rates? So in street rates just mean what are the rates? All they can see. If we see, and there's $100 rate in the marketplace today because people are giving discounts and move-in specials, right? Then they say, all right, it's a $100 rate, and then we think the economy's not very good, so you're going to get let's say a 3 to 6% rental rate increase maybe in this market in this time every single year for 4 years. And it's like, that is so wildly not how we do it and how self-storage works. But that is how real estate works, where it's hard to explain to them, actually, we're going to be driving those people up to $200 in 2 years. Mm-hmm. First of all, the first reaction is, no, you're not, because no one will stay. And you're like, actually, that's not how storage works.
They're
right?
doing it today.
We do it today.
Like right
in
now.
fact, that's the reason why street rates are at $100 instead of $200.
Yep.
And so they see a huge nosedive in rates that makes them nervous, not realizing that, no, they're doing it because they're going to get them back up in a very short period of time. We focus more on that lifetime value. So the lifetime value of that customer, total products, insurance, length of stay, rental rate increases, right? And that number is so wildly different than that offering price that we give. But banks, which makes sense. If I'm a bank, even knowing what I know today, if I'm a bank and you're like, you want me to loan you $10 million, and then you're saying it's going to be worth $20 million, and the data that I have is, trust me, bro.
Yeah.
Right? Like, they're not wrong. I'm not saying that they should just, accept these crazy things. Like, it's, but they are wrong in the fact that that's not how it works. A perfect example that we even gave and we talked about with my portfolio, we had markets that we were 26+% down in street rates, and our overall revenue of that portfolio went up 30%. Mm-hmm. And if you look at the bank, first of all, that doesn't make sense, right? They're looking at rates just going down, 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 down. We have these newly acquired properties. Our revenue's going up, even though our street rates are dropping.
Right.
So they're sitting here looking and saying, let me get this straight. You dropped rates by 25%, but your gross revenue is up by 10% at that property?
It's hard to understand.
And it's like, yeah, that's how this works. And this is the reason why we say you got to treat it like a business. And two, this wasn't really us. This was Extra Space. They pioneered this. If I was not saying, I don't want to give them simply the credit, but they're the ones that did it at mass. Mm-hmm. And they used it through technology. But when Extra Space came in and they merged with really what had happened, the guy that came in and acquired it and started to run it, he came from a tech background, which everybody was like, what are you doing in this weird asset class called storage? You're from a tech industry, right? You made tons and tons of money in tech.
He's like, hold my
and
beer.
He's like, exactly, 100%. And he came in with that same approach and said,
so cool.
No, we're going to use technology, operate these things like a business. And, that made him a billionaire or whatever. Mm-hmm. And they really mass produced this approach. And that, once again, we talked in the other one, so I won't go at that. All started in 2008, and now technology. That comes with good things and bad things, as we're seeing in the marketplace. But to focus more on the 101 type stuff, when we're running it, how we look at it, day-to-day operations is a combination of, we talk a lot product market fit, so how is the product being presented, maintaining that perceived value to customers, then the servicing of the customer. So you have that front end part with our customers, okay? So the product that's being presented, that's being sold, how they get into the product. So operationally now, how do we find and acquire a tenant? And those two things come together on that front end. On the back end is more of those things that I was talking about on the operational side. Now you may be saying, hey Jay, this is a lot. It's only a lot because I like to dive deep into things and go way beyond what we should be. But it's not actually a lot. So we first got to cover the original business model, which I try to make sure everyone understands that our original business model was that we were going to make people pay their bills. We were going to answer the phone and we were going to try to let people know that we were there. That was how we were going to run those businesses, right? And the reason was because that was failing so miserably. That model still works together works today in a huge portion of the United States.
Absolutely.
So like this, and two, you may be saying, well, I'm not going to do all that. I don't think even if you're not running a storage facility. So even if you're saying I'm not going to be doing it, if you do not know how the game works, how in the world are you hiring the right person to run your facilities? So whether you're doing it or not, if you're hiring a third-party management, you need to know, right? Like you need to know what's going on. You need to know how that works, because that will dramatically affect, obviously, your asset performance, and especially in what markets.
No, it really will. Those operational factors really do play a huge role. Even today, I mean, we played with a lot of different management styles, implementing more technology and not, and, having more manned and unmanned. We've played with a lot of different structures, both with technology and then also with the human capital portion of that, where we're saying, okay, we're going to have this management structure and these different tiers of management. And I mean, just recently we've kind of gone through and redone a lot of our operations and management at the facility levels, and really have gotten back to more of that customer service based. The different ways that we can continue to drive value in ways that maybe other facilities aren't, or that we just recognize works well for us. And that's how we operate as a business. So it's been...
and that's a big factor, too. Everyone, I think it's what Connor just said. There's two things that I need to point out because it's really important and true. First of all, we test a lot. I mean, if there's anybody in this industry that's like, yeah, I'll test something, and if it doesn't work out, that's fine, because I'm doing it on my own money. So that's really allowed us to do things that no normal investor or somebody would do. Our property management company, everything else, I'll test something out, and if it fails, literally I'll take away like a management fee or something to the investors, because that was us, I was just playing around and it didn't work. I can just spend my own money to try things. We did this with technology, from hard wiring, keyless entry systems that had never been done before that we worked with Janus. Right now, I'm in the middle of negotiations on a big new project that will be first of its kind, right, in a way that we structure and do things with Janus again. And we're willing to say, I want to try this technology that will work within certain management communication structures. How can we thin this out? And if it doesn't work, just say, it didn't work. Because this is a business. So I believe that businesses that are innovative survive, and businesses that don't die. Storage allows, though, you to not be innovated and not die, but it doesn't mean you won't thrive. And so that is the problem, though, with storage in a lot of these industries, is because they are allowed to not be forward-thinking and innovative, and they can make that work, right? Because their cost basis and everything is fixed, and they just might not be getting the upside. So therein lies our business strategy and opportunity. We're finding the people that don't. We come in and we get all that upside. Now, that is become mass product and produced. It's weird. It's like somebody wrote a book on it and told everybody exactly how to do it.
Guys.
So I know. Jeez. So over the last 5 years, that model has become standardized, especially in the private equity area. And so you need to know, too, who you're competing with. So we are willing to try to implement and to throw out what works and doesn't work. That's something I never want to lose, and I never don't want to do. A lot of people are way too afraid of short downside to forego long-term upside, because in real estate, they hate that. And that's something we even explained to our investors. We're like, listen, we make a lot of short-term changes. And like that consistency that you see with just like it being okay, here's my straight line distribution or whatever. That you don't get that with us. Why? Because we're doing value add. So we're trying to dramatically increase revenue, which makes, I don't know why everybody doesn't do that. Why? Because my downside is limited. I'm not going to tank it. So I have an opportunity to play with things in the short term to get an exaggerated upside in the long term, why wouldn't you do that? In most businesses, that's not how that works. It doesn't work like that. You screw something up and you can dramatically destroy your business. But we have resilient tenants. It's real estate, so we can. So we are okay. I view it in periods. We have a 1 to 3 year period, then we have a 3 to 6 year period, and then for there out we have it. So our 1 to 3 year period is a system and a value creation period where we're really analyzing it. 3 to 6 years is a stabilize and a equity retrieval. Then from 6 years on, it is maximizing, but it should be stabilized and implementation. We do obviously change and make things and change things along the way. But I think that our approach as a business, though, if you do look at it like a business, you have to be willing to try new things. Because I know you've seen, Connor, every single one of our markets acts differently. And some things that work in one market does not work in another.
Absolutely. You have a totally different tenant demographic. You have different laws, rules, regulations, timeframes. Everything from getting tenants in the door to sending eviction notices to the type of people that you can hire in certain areas. Not only the demographic of tenants, but another factor that's really been on my mind lately is this demographic of talent. Attracting top talent. How do you attract and retain talent? And, when you're in these different markets, a lot of times, too, if you're looking at some of these really tertiary markets, that's something that you might want to consider. We've got facilities in areas that it is a total nightmare to try to find good talent that's going to stay for any period of time.
Yeah.
It's just a revolving door.
Yeah.
And you look at
difficult.
You look at the cost there, and it's huge where, maybe it does make sense in that market to go more remote managed in a certain way versus another property or facilities where you have these really high-end tenants and expectations, and maybe you need somebody there to smile and greet them every day and pay them a good wage to be there to do that.
And your acquisition will fail if you don't.
Yep.
A lot of people look at it, they're like, well, we implemented all this technology and everything so we can be totally remote. In fact, I had a podcast with
Jonah Hall.
Yeah, Jonah Hall 3 weeks ago, which is awesome. I love his model, right? He's great. He's a partner with us in Tenant. And his model and how he's really perfected that and that works. And they're doing a lot of the
No key
tied with the Hummingbird product from Tenant. But then they do it on a smaller conversions. Like they'll go in to do smaller conversions, right? And then it's totally not just manless, but it's all done from your phone, right? And now we did, so take his model and take our model on a conversion, and on that conversion we have 2 full-time people and you go, well, what's the difference? And the difference is simple. We allow and can do all those things, but our projects, like with our expansion, it's 160,000 square feet, right?
Yeah. 1,000 units.
We're at like 1,200 units or something like that. We have a road that actually goes through the middle of the building with pull-offs, drives, right? It would actually, we're doing well over $2 million plus in revenue at that facility. We would lose money by not having those people there. So the investment in that person at that location, the reflection of it on our overall revenue and net NOI, it's not worth losing that little $50,000, $60,000 that we pay that person to try to make that up on the NOI, because we would overfill that on the loss of NOI without them, right? So we both do the same thing, but then you have 2 different properties, both conversions, both the exact same technology. That's why I'm using him as an example, because it works very well. We're using same products. He thinks just like we do. A great podcast. Everybody go back and check it out. But in certain circumstances, right, doesn't work. Now, like Connor's saying, we have other assets that, no, his system actually works better on those products that we use. And we have to be adaptable for that, and we have to use it. So it does change it. It does change predicated on market, because the market that we have that huge facility into is a high growth market. What that means is we can get away with way more turnover. So our storefront is it's beautiful, right? All glass. You can see through into the facility, through the office, outside, and it has, it actually has computer stands, like touch screens. This is the one that we did with Reed and Lance. They're my partners, and then we've had them on other podcasts. You can go check that out. But it's very new age, right? But because it's such a high growth market, we want people to actually come in because we can sell them in that environment. And two, we have so many people coming in. So it is more than just, we have both the ads, we have both the direct, meaning our ads, acquisition of those customers that never come in at all. But then we also have we have so many units that a rotation of 10% occupancy a month, you're talking about 130 plus people a month. If I'm in a low growth market where I don't have big turnover and I don't have as many units, right? All of a sudden, you may still be getting the same percentage of revenue growth. You may still be getting the same occupancy, but you may be down to like 12 people turnover a month. That is so much more manageable to do from the back office and using technology than saying we will have anywhere between 100 and 200 people turnover, right, at a facility that has over 100 or 1,300 units, right? So this is the important piece that we look at with business model and technology. And when we're on here, guys, telling you this is our model is a business. So it's adaptable to what the market and customers want, like Connor's talking about.
No, exactly right. And from that standpoint, I mean, you're looking at this as a business, what works for that market, the product, the people, what management style works, what technology works, what doesn't, and being able to actually go in and apply that and succeed. You can't just, like so many things in storage or anything in general, you cannot just go and apply these generalities to and these averages, whatever you want to call them, to the market as a whole or to the asset class as a whole, where there's a lot of big players that are moving more and more towards remote management. But the fact of the matter is, with the amount of people moving out of units, say again, this example of 1,000-unit facility, there is just you are going to have presence at that facility in some way, shape, or form.
Yeah, 100%.
Unless you got some crazy AI robots that you have cleaning your facility or something, which would be cool. Let us know. But you're going to have a level of interaction there. And again, too, that other aspect, I mean, I'm thinking of one of our assets, here locally that we've recently implemented and tested out some of this remote technology. And, as we're talking about that, even in this conversation, it's a high-end asset, high-end clientele. It needs someone there.
Yes. We immediately saw the effect of not having someone there.
Yep.
And I think that was also due to the individual market itself. And this was one of the things that we found shocking, right, is how much it mattered at some assets and how much it doesn't at others. And I find people that are not willing to budge, they think, this is the model, this is how it works. Okay, that is the idea of a real estate investor.
Right.
When you're running a business, it's what your customers want.
Exactly.
How did they want to buy? I see this in areas where somebody goes and buy or builds a 3-story. So we saw this. This happened in Iowa. We went to a market where we said there's 6 square feet per capita. This is a great development opportunity, had great growth, and we were looking between this asset and one that had 15 square feet per capita, and we were thinking the one that had 15 square feet per capita we didn't want because it was obviously oversaturated. So Brian Mullally and Connor and I, we flew out to do our market research and everything, and we were shocked at the low square footage, but then we went to certain facilities that had been open for 3 years and they weren't full. And at the time, this was a while ago, but at the time it was like, oh geez, we couldn't quite put our finger on what was wrong with the market and everything. And as we went back and started to look at the competitors, I think it was pretty clearly a product problem, meaning that in this city, and Iowa or Nebraska?
It was Iowa.
Iowa, yeah. In Iowa, they had built a 3-story climate-controlled building that they did because you get higher rents per square foot and you can put more units in. And that facility was not full 3 years later, and they were discounting rates and everything. Why? People didn't want the product in that market. So the real estate guy said, this makes sense. Revenue per square foot, I get more units, it's high end, it's total class, right? Everything else like that, which it was. The best facility in the market. There's no question.
That was beautiful.
Beautiful.
Yeah.
It's
Brand
so
new.
much nicer than its competitors a mile down the road. The competitors a mile down the road, all full and same or higher rates. Simply due to the fact that they didn't understand what their customer wanted. They approached it like a real estate investment, and their customer's like, I don't care how you look at it. I don't want that. And this is a classic self-storage mistake. We see this all the time, and we make it. We've looked at products, and we said, oh, that wasn't right, or that was wrong. One of our great strategies that we have is we actually buy products and then shape them into what they should be. We're changing units, things like that. But we have a product that we bought about a year ago, and that product was, so this was very, very interesting. In that market, we actually see a direct correlation because it was about 93.4% occupancy when we bought it. It is now 70% occupancy. Our revenue is almost double than what we bought it, but that's another story for another time. But at that 70%, a good story. But at that 70%, we're trying to fill up the rest of it, and the market had changed so much through COVID and after COVID that what had actually happened is that market no longer wanted a certain unit size that had been very popular pre-COVID and pre-inflation and pre-high interest rates. That product now is not in high demand. So out of our total vacancy, 65% of all vacancy comes from that one product type, that one unit type, right? Well, that is a classic thing where the market shifted, okay? We have to shift with the market now. And we didn't know that. We could have never obviously foreseen COVID, what customers would want, what they would do. But that's irrelevant. We've got to meet the market. So now we have to figure out how to set offerings. And some of the things that we're doing is we are actually changing because I can actually tell you how to work on this. So here's some tactical things that you could do is we look at it and say, all right, this unit doesn't work. These units, these other three are working. So this is a 10 by 15. And what happened was if you went higher than 10 by 15s, so when you got to the 10 by 30s, things like that, there was demand. And when you got down to more of like the 10 by 10s and lower, there was demand. It was this mid-range that just got obliterated. And the reason being, I think, was inflation, interest rates moving. The bigger units was popular, but the bigger units, the 10 by 15 was a cheaper version of the bigger ones. So people that were more price sensitive took the 10 by 15s instead of the bigger ones. And during inflation and everything else, and they were moving, and so they needed one, so they didn't care. That whole segment just got hit. That price point doesn't work anymore. So now all of a sudden it's, all right, how do we meet it? So then it's, if you're looking at a unit, the price point to the measurements in the market, I want that product type. The first thing you have is when you look at it and say 10 by 15, I don't want a 10 by 15. So then they just move on and go to the next place. So the first thing you got to do is say, no, we're selling a 20 by 30, right? 20 by 30, this one's special because it has 2 doors. You immediately change the product.
Well, I don't want the wall in there. Cool. We'll get rid of the wall.
We'll pull it out, right?
Whatever we got to do.
You're exactly right. And so it's, and then, but even people that like, you can discount that to the other 10 by 30s because there is a wall, but they're side by side, right? Some people are like, okay, I just care about the space. And the fact that it's discounted because it has a wall, that's great for me, actually. Then you've now changed completely that offering to the market. You're matching what the market wants. Even though it may not be perfect, you offer it at a discounted level. And if it's too much of a problem, remove the walls. And then you've now changed that unit up, and that is now going to get absorbed within the market. Now, this can happen the other way around too. You may have too many big units. So I met a lot of people that were trying to build big storage facilities, just big units. This was also the same with people that were just trying to build just big RV spots. That always scares me. Always. I don't like that. There's a benefit to it because you're so specialized, but the problem is if that market shifts on you and you get in a point, because what happened was those big units that people were trying to sell, the reason they were doing it is because there was demand at the time, but also you could charge. So let me share with you an example of underwriting. We're developing a facility where the drive-in RV units in that marketplace were very, very popular. And so we put a lot of them in. We had climate-controlled drive-up. We had a good mix, but still there was a lot of them in. We could charge $600 for those enclosed in this area, average income over $140,000. And we track a whole lot of that stuff. You can see, actually, I think we did a breakdown of that on our YouTube. Go check that out. But from there, we could look at it and say, we could charge $600 for that unit. Well, once interest rates went up, everybody stopped buying RVs because they couldn't finance it. And then inflation tied with that, everybody's appetite for huge expenses went down. So now that $600 RV in that market is selling for $200. Now for us, it was an easy adjustment. We literally just quickly changed the unit mix. We actually increased our revenue per square foot. We had a better offering for the product. But it can show you how if we didn't have the ability, that was the only thing we had in that, we're now getting 30% of the revenue. Mm-hmm. And that you got to be careful with that. So if you're going to do that, the best way to do that is to go deep into the business model where you're like, and how I've seen this done best for people that do it is we're a full service shop. So now we're charging $600, but we do so much more. We are not a storage facility, right? Mm-hmm. We are an RV servicing center. So we'll clean it. We'll do all these things. We'll pick it up. So what you're doing now is you're not the same product anymore, right? And that's how business, and that's how you service your customer. Those ones will do well and survive because they're hitting the market that is willing to pay for that. Where the other ones, once again, it was that mid-range. That's the ones that got hurt. And it's an old adage that I've always heard in business that and we saw through our consulting and servicing everything, you pick the market, but you never pick middle class because middle class is way more fickle. So you either go high or low because what middle class does is they end up separating into one of those buckets. Mm-hmm. Times are good. Middle class goes up to purchase higher end, better products. So all that happens is when times are good, you get more demand. But the people that are buying it are generally insulated more from fluctuations in the market. So even when things get bad, your core audience doesn't hit that much. Bottom, same thing, right? That's you go through downtimes and middle class goes and they start cutting back and they start going down. So your bottom expands. But then too, even though when times get better and everything, there's always a price conscious class. So when you look at that, you got to realize those customers' needs, what's driving them and their purchasing decisions. So many people don't look at it like that. They just simply look at it as a unit and they look at it the market. This is what we can charge. When that's a momentary thing. And the problem is they were building and they were buying on 3 years that was so far from normal. There was no way that we were ever going to stay in anywhere near that. Yeah. You could not put out thousands of enclosed RV units in a city charging $800. That's what it was, in our market. It was $800 to $250. But we are getting in our other markets $600. You can't charge $600 to $1,000. All the RVs do it only because money's free. Everybody's buying RVs. And then when that changes, you have all this inventory and prices just crater. That's the same with parking. We actually have an investor, and he's also my friend, and he built a open parking area. So all he did is fence it, make open parking. Very popular because it's very simple. Now, open parking facility just a few miles away from where he was doing this was selling for $6 million. All it was gravel and dirt. And I had several people reach out to me from all over because it was in our market where I live. And that's what they do. They want to look at it. And I go, here's the problem. It was the total of 6 to 10 acres, maybe 10 acres. And I go, you can buy 10 acres for $500,000. And the city's going to let you do open parking. That's why they're there, and that's why there's so much. There's no rules against it. They don't care. So then I always ask, what are you paying $6 million for?
Mm-hmm.
The dirt itself is worth $500,000, right? And there's no barriers of entry. And somebody actually bought it for $6 million. This was right before the crash. Then he went out prior to that and he built his, and he only got 30%. He couldn't even fill it up. And so he luckily just changed up and used his land differently, which works great. And he had the ability and knowledge to do that, so he could. But that was in a time where that open parking stuff, that was selling like hotcakes.
Mm-hmm.
I mean, but so many people went in and built it. And I just keep going back and thinking about that person that paid $6 million to where, I mean, I'd be shocked if it was worth $3 million today.
Mm-hmm.
I mean, there's no intrinsic value whatsoever. It's so easy to do. Everybody can do it. And today, try refinancing that with a bank today.
Yeah,
you
no
could
kidding.
3 years ago. So you got to understand that these one product, you can get trapped in them. Once again, it's okay to have a business model that does it, everybody. I have a friend that does contractor storage, but that's what he calls it, right? It's contractor storage.
Consumer product fit.
Yes,
Yep.
exactly. So he's very specific on that and on that niche, right? So really, when you're looking at a business, once again, this customer and understanding how that a customer is affected during different cycles. How price sensitive are they? And what are you paying for? Does this model work if the environment changes? And a lot of times the answer is, oh, it won't change. And we got a lot of that over the last 3 years.
Yeah.
It won't change.
Till it does.
Till it does.
And it will.
And it will. 100%, everyone. It will. And when you're buying, when you're building, when you're operating your facility, you need to be able to change. The fact that you don't like technology and what it's doing, the customer doesn't care. Your acquisition of your customer, even though you don't like what's going on and you may not like how you have to play the game, everything else, customer doesn't care. And what happens is he just doesn't know you exist anymore. So if you are with a third-party management system that does not have, a third-party property manager who does not put huge emphasis on this and have arrows in their quiver that they can pull out, that they can defend, that they can look at and talk about operating in different cycles and how to mode, how to change things, technology that they're trying to stay on top of. Instead, they just say, self-storage is, really simple. We're just going to focus on the fundamentals, right? It's not that that doesn't work and it's not important, but what it means, though, is if things change from what they view as a simple business model at that time, you could be really in trouble with the person that you hired because their simple system doesn't work today.
Right.
I've seen this through 2 cycles. We saw this and we made tons of money after the great financial crisis, not because where real estate prices were anything else. It's because we had operators that were operating from 2010 to 2016 like they were from 1995 to 2000. Yellow pages, no online, nothing, no anything else. They didn't change, and they were getting slaughtered. And by slaughtered, I don't mean they were losing money. Not at all, because they had such a low cost basis they could make money. Their upside that they were missing out was crazy. I mean, you're talking about valuations that we changed by double in 2 years. And this was simple stuff, right? But this happens. And we are in a marketplace where people are still acting like the last cycle, right, will work. So don't get caught by it, but it can also be an opportunity. The more you understand that marketplace and your customer, the more you can adapt to it. And this is often a hard lesson, I know, because we learn it. Because I don't know what's going to change. We're looking for our customers to tell us. And guess what, you guys? Your customer tells you usually in a bad way. Why aren't we getting new customers? Why are customers leaving? Why won't they accept this price? Why won't they? Right? That's what tells you. If you said, oh, my customers like it because it's 100% full and nobody's moving out and everything, that could also be a signal to you. You're doing something wrong. Meaning you're making it, you don't have one customer, it just fits everybody. So that means you're just either competing on price or something else, and you're leaving all this money on the table. So listen to them. Don't be afraid of change. Don't be afraid of trying things out and maximizing things, right? And don't be afraid of losing customers. So many storage operators are just terrified that they're going to lose their customers. You can't do that.
No. And another thing I'll add is don't afraid to be wrong. To that list of don't be afraid. That's one of those things that, again, don't get married to an idea, don't get married to a concept and think that this is the way that it has to be. Again, be adaptable, be flexible.
I mean, we are. We're wrong all the time. In fact, we try to be wrong, because if we're not trying new things, we aren't wrong.
Yeah, we're pushing the envelope.
Yeah. And I want to know. And if there's a great way that an operator's doing something, I want to know about it. I want to implement it. I want to try it out. And that may not work in this case or whatnot. But the fact of the matter is we want to be testing. Now, the key is to figure it out quick. And I have been slow.
Okay, everybody, our sponsors really help keep this show going. Now, a quick word from them. One of the best ways to optimize management and to increase the value of your self-storage facility is through property management. And that means you're going to need really good property management software. That's where Tenant Inc. comes in. These guys have a huge amount of tools at your fingertips that you guys can deploy and put into motion to extract the maximum amount of value and deploy the maximum amount of value at your storage facility. Again, this is Tenant Inc. Be sure to check them out. They're all things property management. It's truly your one-stop shop. Check them out. Link is in the show notes.
Now, the key is to figure it out quick. And I have been slow. And I think that the last cycle made a lot of us slow. It was too good for too long, and we did not have the customer feedback that we needed. So we didn't even know when there was problems until it came up, right? And I saw this in one of our markets particularly. We had a lot of assets in. And this market was unlike any market I'd ever seen, is dominated by directories. Like, I've never seen anything like this. No market is still, not even markets we're in. I've never seen a market like this. And we did not want to use directories. And we didn't want to play the game that the REITs were playing on the rates, things like that. That killed us. And I was way too slow. I waited months and thought, no, we're going to do this better. So the precautionary tale in that is don't sit around and wait to think that the customers or the market's going to return to how you want it or do what you want it to do. Adapt quickly. Be looking at your reports month over month. Look at individual unit types. Look at move-ins. Look at it all to try to understand what the customers are telling you.
Exactly right. Exactly right. And so much of that goes into just everything that we're talking about in relation to running these assets like a business. You are looking at that revenue, that occupancy. You're looking at it. I mean, we look at everything weekly. You know, there's a lot of these different, data points that it doesn't make sense to look at weekly, of course, but, at minimum, look at these things monthly, look at the trends, get the feedback, and get granular. Don't just look at overall occupancy, look at your occupancy based on unit type, because again, you'll be able to identify what units are performing well and what aren't. If you need to make adjustments, launch promotions, do whatever you got to do to get that leased up. Just so many ways to be creative, but it all comes back down to, again, all those fundamentals of product market fit, supply and demand, all of those things as far as running a business. That's what storage is, and it should be and can be. I mean, really, the question is: do you want your business? Do you want your asset performing to the highest of its ability?
Yeah.
Yes.
Yeah.
Run it like a business.
And this also provides opportunity, meaning that you can see opportunity. Our fund two that we have open now, we just completed. We have one asset that's under contract that's closing, and it's our last one within the fund. And every one of these was so unique that we had this amazing opportunity on. We've been very picky. And I mean, we've got seller finance deals. We've got under replacement cost ones. We've got expansion opportunities in markets that they don't let you build, but these were grandfathered in, so they couldn't say no. And there's but this might be hard to operate in this way. We'll figure this out because the opportunity is so tremendous, right? And it's already cash flow positive. We already own the assets, which you guys can find Fund 2 in the link below. Check it out. We're wrapping it up in 2 months. But all of them have such huge opportunistic and revenue value with the downside already met. So unlike a development, right, with these, it's like, no, we have an expansion. So we can add 200,000 square feet that outside the cost to build, we have no expense change operationally. That's just margin and value. We have another one that we are adding on. It's something crazy, like, 200 parking spots and covered and some areas that cost us nothing to do. And even at like 30 cents a square foot, right, it adds 200,000 to the income on a cap rate. That's millions, right? And that's easy. It's easy for us to measure. It's easy for us to see. It's easy for us to do. And then we have other ones that are changing the product that are there's just so many things that once you do these things and you have these tools, you can see huge upside, opportunistic upside, but once again, your downside's already fixed because you're purchasing it predicated on that profit that it's generating. That's pretty much what Fund 2 is full of right now. And it's already cash flow positive, and we haven't even closed it out, which is funny because I did not think that would happen. But it's exciting for me because this is opportunities we did not have 3 years ago.
Yeah.
Because we did not have customer feedback. We couldn't see in the marketplace where vacancies lied. So you didn't really know. Everything was full and everything was awesome. So it was really hard to find opportunity.
So much competition.
Yeah.
It was a nightmare there for a couple of years. But no, I'm glad to be getting back to reality a little bit. That's going to be nice. But there are a lot of these things that, problems that need to be solved. A lot of cleanup work we got to do to make sure that everything's performing top notch. And again, do all these value adds and really start driving revenue and value and growing these assets. So
100%.
So it's fantastic.
All right, everybody, back to the basics. Don't forget, it's a business, not a real estate investment. So treat it like one.
Thanks, everybody.
Thanks.